attention to the markets now. The local index looking set to compete with mixed global markets in early trade. Investors still digesting the latest sanctions by Europe on Russia, as well as an improving COVID-19 picture in China. Locally, though, all eyes will be on the unemployment data, which is expected from Statistics South Africa this morning, and with analysts expecting a grim picture. Makwe Masilela, Chief Investment Officer at Makwe Fund Managers, and he joins us sadly via the phone because the online platform that you and I usually use, Makwe Masilela, not working as we want it to, but nonetheless, let's soldier ahead. How is the JSE performing in early trade, in particular, ahead of that unemployment data?
Morning to you and to the viewers. Yes, unfortunately, the JSE opened down 0.4%. Remember, yesterday we closed up 2%. And so I think we're used to this, that you have a nice rally, then the following day it gets to be sold off. But today we also got some bad news coming out of China. When you look at their official manufacturing PMI numbers from May, they were at 49.6%. Though it's an improvement from April, but it's still below the 50 mark. So markets are kind of cautious, and we'll see how it turns out. And resources are the ones which are taking down the JSE this morning.
Yeah, well, let's look ahead to those figures of the first quarter of 2022. They'll be published later this morning by Stats SA. What picture are you anticipating? I've just had a conversation with COSATU, and they're saying, well, with the load shedding that's been on the go, the state of unemployment in South Africa will probably be worse.
Definitely, I agree with them. Remember, our economic growth has been slow and also uneven. I mean, remember, quarter four, we know as we're talking now that unemployment is sitting at 35.3%, and we only had a 1.2% GDP growth, let alone our youth unemployment, which is still high at over 66.5%. The issue here is the economy is not growing, and as much as we're trying to get out of the COVID issue, trying to see that things will be shaping up, we realize that, remember, quarter four, the most culprits, people who lost most jobs were in manufacturing and construction, and we don't expect to see any improvement when it comes to between January and March this year. Yes, the floods are not going to be reflecting as yet because they started in April, but going forward, we know that the outlook doesn't just look okay, because you still have to factor in all the effects of the floods going forward. You still have to factor in the Russian-Ukraine war. And a simple analysis told us that when things keep on going up, we all complain about inflation. What do you do as a business person? Because you know that one of the biggest costs continues to be wages. Then it's easy for you to retrench people. And unfortunately, businesses have a funny way not to rehire those people. And that money, because the guys are using those savings to try to meet up with other costs. As COSATU mentioned, the likes of electricity prices going up. We don't even have to mention petrol issues and other general costs. Just look at our producer price index. You can see how high it is. So yes, it's not easy for businesses, and as a result, that will be reflected on our employment numbers.
Let's talk company news. Famous Brands releasing its results for the year, which ended in February for that company. How have they fared in the period under review?
The recovery, unfortunately, was slowed by continued COVID-19 trading restrictions, weak economic conditions, and to a lesser extent, the July unrest. And we know customers are eating out less due to financial constraints, and the guys are continuously looking for value for money. And yes, COVID did help to some extent, because we've managed to create a cleaner, safer, and more efficient establishments. Revenue up 38%, profits as headlining earnings per share up 568%, but to remember, it's coming from a low base. If you compare that with end of March 2020, is down 24%. The same can be said when it comes to operating profit, though they're up 428%. But comparing that to end of March 2020, they're down 1%. The concern is that net debt has increased by 23%. Hence, their gearing is up 58%.
Let's conclude the conversation with Goldfields, set to acquire. It's a company called Yamana Gold. Who are they, and what are the specs of this acquisition?
This is a Canadian-based company with headquarters in Toronto. They mine gold and silver. And yes, Goldfield, if you look at this deal, they will be giving them 0.6 Goldfield shares in exchange of one Yama share. So we just have to be clear, it's an all-share deal. There's no exchange of money, and the deal is going to be valued at almost $6.7 billion US dollars. In the current exchange rate, you are talking just over 103 billion rand, and that will result in Goldfield owning almost 61%, and then Yamaha 39%, and the company will be headquartered here in Joburg, and it will be a top 4 global gold player with operations in South Africa, Ghana, Australia, South America, and also Australia, sorry to repeat myself. And the guys will have high quality, long life assets, and that will strengthen their financial and operational capacity. So I guess this is a good deal for both of them.
Makwe Masilela, thank you very much for that market update.